everybody, and welcome back to NYU Stern's FinTech Conference, No Borders, No Barriers. I'm your host, Kathleen DeRose, and I'm the director of the Fubon Center for Technology, Business, and Innovation. And I am very delighted to introduce our next academic panel on artificial intelligence, hosted by Professor Foster Provost. Foster bridges the gap between commerce and academia, as he serves as a scientific advisor to Unicorn Compass, as well as being my colleague at Stern. Foster, I'd like you to take it away to introduce your panel. And just as a reminder, for those of you who want to ask questions, please put your question in the Q&A box at the bottom of your screen. Take it away, Foster.
All right, great. Thanks, Kathleen. Hey, welcome back, everyone. I'm delighted to be joined on this panel by my colleagues, Professor Vasant Dhar and Professor Charles Elkan. They were actually my first choices for the panel, and I was delighted that they both agreed. Vasant and Charles both have substantial experience building and deploying AI systems in business, in particular in finance. They're both also at the pinnacle of academic thought leadership. I'm not going to read you their full bios and all their awards. You can go read on the conference website. But Charles is a professor at the University of California at San Diego, where he's made stellar contributions to the science of AI for decades. I basically, if I see a paper by Charles, I will read it. Doesn't matter what the topic is. He also ran a large data science group at Amazon for several years before moving to Goldman Sachs. And now he's leading a well-funded fintech startup, bringing machine learning to the capital markets. They're currently in stealth mode, so I'm looking forward to learning more about it later this year. Vasant is my colleague here at Stern, and in fact, the reason that I came to Stern back in the 90s from working as a data scientist in industry, besides being a standout academic thought leader for AI and business, Vasant brought machine learning to Wall Street in 1994 at Morgan Stanley, where he deployed some of the first machine learning for hedge funds, eventually building an end-to-end automated learning and decision-making system. So regarding the panel, Vasant's research has been focusing on the question of when do we trust AI systems with decision-making? And this is become one of the most vital questions we face these days as AI becomes increasingly ubiquitous and increasingly embedded in other systems. And so that's what we're going to spend our time now talking about. And so Vasant will kick things off. I'll dig into one particular relevant part of that question, and then Charles will wrap things up by stepping back and helping us to think about what even are the right questions to be asking. We'll speak for 10 minutes or so each, and then we're going to open up for discussion. So as Kathleen mentions, put your questions into the QA box, and we'll address them later on. Without further ado, let me hand it off to you, Vasant.
Thank you, Foster. Delighted to be here. Welcome, everyone. So let me kick this off by asking, or by just telling you why I got interested in trust in AI. And it happened for a very practical reason. As Foster mentioned, I went to Wall Street in the 90s. People viewed machine learning with a high degree of cynicism at that time. We'd just gone through one of the AI winters, and people would sort of look at me and say, like, really, machine learning? I hope you're not using these things called neural networks. And how things have changed. These days you can't talk to anyone without them asking you, are you using neural networks? But anyway, let me just sort of back up a little bit and just frame what I mean by trust. So, the way AI works in decision-making is that, the traditional way is that machines support decision-making. Humans make the decisions, and machines do all of the grunt work and the analysis for you, right? That's sort of the traditional decision support way of looking at decision-making. The other way to look at it is where the machine actually makes the decisions. And there's always human oversight, but the machine does all of the heavy lifting in terms of potentially even building the models, and then just deploys them. And this is what I really got interested in, and this is where most of my research has been in the area of automated decision making. And as Foster said, it started in the mid 90s when I went to Wall Street, and it started with a simple question that I had, which was, could I design a machine that could learn to trade like the best humans, right? That was the question that I went with, and it was a completely open-ended question. I was, I guess, cursed with a little bit of initial success. I joined the proprietary trading group at Morgan Stanley, and if you know how prop trading groups work, they want to know everything you know, but they don't want to tell you anything they know, which I thought was fair enough. And so I told them, just give me all your trades over the last 5 years, and I'll tell you if you could have done better. And they said, well, you don't need to know anything. I said, no, just give me the trades. And so they did, and I went back and did sort of the machine learning based hocus pocus. And I came back the next week. We used to have our weekly meetings, and they said, so Vasant, what'd you find? And I said, well, I found that when the volatility is in the lowest quartile, your trades are 3 times as profitable as they are otherwise. Silence around the room, and suddenly everyone's yelling at each other, saying, I've told you volatility mattered. How come this guy who knows nothing is telling us that it matters? And so, I asked them, I said, can anyone explain, what you're talking about? Like, why is this the case? And they said, no, we really don't know. We can't really explain it, but we feel it, right? I mean, we feel that every time volatility spikes, we lose a lot of money. So it's interesting that you're, telling us this. And, to me, it's this sort of revealed, a basic thing that I've observed over and over again in pretty much every predictive model I've tried to build. And that is that, you sort of see that patterns emerge before reasons for them often become apparent. And that's sort of a thing I've carried with me and I expect into, in every situation. So that's what really got me started. And, I used machine learning initially to build models, and then I, as the human, would select which ones I like and deploy them, right? So that was machine learning to find patterns in markets, and then, me and my team would look at them and say, yeah, we like this, we don't like this, this doesn't have enough statistical support, this one does, this makes sense, this doesn't. And, over time, I realized that that was sort of a thankless proposition. It was sort of a losing game. And the theory of finance tells us that, humans tend to be terrible decision makers when it comes to investing. And, I realized that I was no better, and over time, I realized that I was doing no better than random. And so, I decided that I really had to sort of automate that process of model selection and decision making end to end to sort of truly be able to ascertain whether the models had any sort of what we call alpha and any sort of insight or not. And that's what really got me into building these automated decision making systems. And so around 2009, I was in the process of sort of automating things and letting the machine do everything end to end. And if you think about it, that's a huge step to take to actually abdicate control of decision making to the machine, right? It's one thing to have the machine do all the analysis for you and then you push the button, but it's very different when you're letting the machine make all the decisions for you. And so, you really sort of got to kick the tires, and that's what I was doing. I was sort of kicking the tires and making sure everything was okay. And then, a few days before we were about to deploy the model, I just asked one of my guys to run it one last time and, let's see the results. And the results looked okay. And I just went one step deeper just to look at whether the decisions were stable. Was it making the same decisions as it had made in sort of the final deployment? And to my horror, I found that they weren't. There were substantial differences in the decisions. And I went back and I couldn't believe it. And it turned out that for some reason, I had left out sort of the initial part of the history. The first 6 months or so out of 20 years had been left out. But I was still surprised at how different the model was that emerged just based on leaving 6 months of data out. And sort of the more I dug into it, the more I realized that what I was doing had sort of some stability issues associated with it. And that led me to this notion that I now call model variance. And it really has to do with, how stable are your machine learning models? And that's, so I sort of got deeper and deeper into that. And ultimately realized how to fix the problem. That is, how to make the model more stable, so that, small perturbations in the training set would not alter its decision-making behavior significantly. And I'm not talking about performance. The performance is relatively stable, but the decision-making was different. And that's what had really troubled me about the properties of that system. And that just got me sort of deeper and deeper into looking at, what I call model variance, and more broadly into, what I began to look at trust in these machine learning-based systems. And so trust for me, or one really important pillar of trust, became sort of model variance, which is another way of looking at the stability of a decision-making system. So that's sort of been my story and how I got to this point of looking at sort of trust more generally. And I've sort of generalized this into a framework, that I've written about and published. And I will just put up a picture of this, if I can get to it. This is not what I was looking for. But so the way I look at trust now is in terms of this sort of framework where I classify every problem along two, or at least two axes or more. And in this case, an important one is predictability, right? So you can see that you can think of this as going from 0, which is completely random, to 1, which is completely deterministic. And trading in capital markets lies on the left-hand side of the spectrum, right? More towards sort of the noisy end of the spectrum. And just for illustration, I put on another problem called lending, which has higher degrees of predictability. And in the lending arena, people build models that make decisions, but ultimately humans make the decision, right? They verify and then they negotiate with the borrower. In the trading arena, the process is, as I said, automated. But I find this framework really useful in sort of, situating different problems on this predictability spectrum. And not surprisingly, I find that the model variance tends to be higher as you move towards the left-hand side of this predictability spectrum. And so I'll just leave it at that, but that's the intuition. If you're actually interested in sort of looking at this more deeply, I have an article that was published last year. It's an academic article, but it sort of lays out these properties of stability and how stability varies, along sort of different points of this continuum. And then finally, I have this other paper that I wrote with my co-author, Roger Stein, on fintech platforms and strategy a few years ago that is sort of interesting. And it's interesting to see how the fintech space is actually playing out according to some of these things that Roger and I had described in this article. So let me stop there and Foster, hand it back to you. And you can take it from here. Thank you.
All right, great. Thanks a lot. Thanks a lot, Vasant. So could you stop with your screen, stop your screen share?
Yes, let me stop that.
All right. So following on that, talking about, sorry, I'm sharing my screen while as I talk. I can't apparently do more than one thing at once. There we go. As I mentioned at the outset, what I'm going to try to do is to dig down a little, dig down deeply into one particular question that, in my experience, is crucial to answering the question, how can you trust AI systems? I want to point out there's actually been a long line of work, which in a separate work that I'm not going to talk about today, but I can actually point people to if you'd like. I've surveyed it. There's a long line of work in the idea of what it takes in order to get acceptance by users of AI systems, and actually understanding the decisions they make is one of them. And so I'm specifically going to be looking at the question of, do you understand why the AI systems that you have make the decisions that they do? Because if you don't understand why they make the decisions they do, you're going to have a harder time trusting them. I don't know why there. Oops. So here's an AI system. It's perhaps a bit stylized, but let's use this as our running example. So our AI system wants to make a decision on whether to grant credit to an individual. AI system in the middle, that's not the individual, right? And then she will make a decision, grant credit or don't. Right. And so inside that AI system, it incorporates knowledge and then inference procedures and business costs and benefits and budgets and other business constraints and possibly some other AI stuff. And that's without even mentioning machine learning. Right. And so if we're going to understand the decision, why a decision is made, right, there's a lot going on in her head. And so what I'm going to do is let's go inside her head. Let's go inside her head and look at like the major pieces of the making of this AI system, right? And so let's zoom in. Let's zoom in on that. So the bottom is just an expansion out of that AI decision making system, where I'll show you what I've expanded out, right? So it was a decision about whether or not we should grant credit. That is basically going to be based upon an input data on the individual and on the loan that they're making. And then the next phase with the tree-looking thing, network in there, that's supposed to represent a model. So there's some machine-learned model. It also could have been handcrafted, but I'm going to talk about machine-learned models. It's a machine-learned model, and that model is going to give some estimation of some quantity. This is the way, by and large, these systems work. And so that quantity might be an estimation of the likelihood that this individual would default on that loan, as an example, right? Then this estimation is going to go into the rest of the decision-making system, which is going to take into account costs and benefits and constraints, possibly other estimations, and eventually make a decision. Right? Now, what about the machine learning? There's no machine learning in there. The machine learning answers the question, where did that model come from? And that's in the top half of the figure. There's some data that was used by a machine learning algorithm to come up with that learned model. And of course, the connection between them is that learned model ends up then getting embedded in the head of the AI system. Right. And I lay this all out because if we're going to understand why the decisions were made, there's like a bunch of different things we might want to understand about the system. Right. And there's actually been considerable academic research and work in practice now. A lot of the research, I'll point out one of my favorite methods in a minute, has made it out into practice. But you can have a question about understanding the machine learning algorithm. Really, this is the realm of the machine learning scientists and the data scientists, and you really kind of need a degree in a relevant field there, right? There's understanding the learned model. That is different from understanding the learning algorithm. And that actually then goes down, and that's part of the system that's making the inference. So you may want to understand the learned model. And in fact, in applications where it is essential to understand every decision that might be made, like for instance, decisions could be catastrophic, and so you may really want to understand every decision that might be made. Understanding the learned model very often is building a very simple model. So we may use a simple logistic regression to estimate default probability rather than a neural network that actually is more accurate because it's more comprehensible. Okay, next in line. Now that model makes a prediction on this particular case. Do we understand why that prediction was made? And then finally, that prediction estimation goes into a decision-making system. And there's another question about, do you understand why the decision was made, right? And so I'm going to concentrate a little bit on 3 and 4, because in my experience, I've been out deploying machine learning algorithms and the machine learned models in production for 30 years. It's actually very often 1, 2, 3, 4 are largely the data scientists need to understand these. The product managers need to understand like 2 and 3, right? Some of the other managers maybe have to understand 3, and then the ultimate stakeholders really need to understand 4. And 4 actually is the place where we have the least research done, and also there's some mistakes that we see. So let's dig into that a little more. And I want to point out, explaining these predictions, number 3, is not the same as explaining the system's decisions. And our favorite way of actually coming up with explanations of the predictions for individual cases are via the importance weights for the decision. So let me just show you here what that means. So here we have a particular individual and a loan. There's a bunch of variables that are the input variables. This person was denied credit. We might want to ask the question, why were they denied credit? So, importance weight explanations. My favorite method, I told you I'd mentioned, it's SHAP. I have a caveat in the deck that basically is like, I do not mean to have this be an indictment of SHAP. I use it all the time. It's great. What it doesn't do, though, is explain decisions, and we see very often people are coming to us as vendors saying that they're going to explain the decisions using SHAP and so on. That's not what SHAP does. SHAP explains. SHAP gives us the important variables, and so we'll see in this decision, the loan amount was the most important variable, and SHAP tells you exactly what it means to be important. I'm not going to go into that in this short amount of time. Annual income of the requester is the second most important. Their FICO score was the third most important. But what this doesn't tell you is which of these features actually affected the decision. It says these are the important ones in a particular sense of importance. It doesn't say which one caused the credit to be denied. Is it just like loan amount alone caused it to be, all else being equal, or do we need all of these things or what? So there's another kind of explanation called counterfactual explanation. A bunch of people have done this. I've done a little bit of work there. And the idea is, can you actually say, if we take these features as input that is evidence of, obviously, if the model normally would grant credit and now it's denying it, there's some evidence in there that the person may be likely to default, that the person is high risk. Right? And these are telling you what's the sort of evidence, right? And so the counterfactual explanations say, what evidence, if you were to remove it, would you no longer get the same decision? So would you no longer reject credit? So if you were to remove loan amount, from this particular customer, would that actually say then you would actually remove it? What do I mean there? Like replace it with like an average loan amount. This is above average loan amount, replace it with an average loan amount, right? Would they get credit, right? And so that's what the counterfactual explanations do. And this is a view of 6 counterfactual explanations for this particular loan. And let me explain this table to you. So obviously the rows show the features, the same features we saw on the chart. And the columns here, 1 through 6, are 6 different explanations. So let's focus on explanation number 1. What does explanation number 1 tell us? It tells us that loan amount, first of all, that it is too large to grant credit for this particular customer with the other aspects of this customer. It tells you just how much larger it is than the mean. So, and because there's nothing else marked here, it's telling you loan amount indeed is enough. If they had actually asked for an average amount of loan with their other characteristics, they would have had credit granted. But you also may want to know, maybe they need that much money. Is there some other factors that might have played a role? Okay, yes. Explanation number 2. It doesn't reference loan amount at all. It says actually annual income being too small and the annual income was too small given the low FICO score. And 2 and 3 are both saying that because we just have the top and the bottom of the range of the FICO scores. So that's a different explanation. It's saying your annual income is too small given the FICO scores. And actually, it also says annual income is too small given your short credit history, right? And so you can see how this is giving you a different picture. So the idea isn't necessarily that you want to do one of these things and not the other. They give you 2 different pictures to help you explain the decisions that are being made. By the way, just as an aside, I have it in the middle of this document. It turns out that the highest weighted feature may actually have had no impact on the decision, and a feature that's critical for the decision could get a 0 weight. Right. And so there is not actually a necessarily a direct relationship between the feature importances and the decision being made. But if it has impact on the decision, it will be part of one of the counterfactual explanations. Okay, so that's it for me. And so I'd like to pass it on to Charles to sort of, I think, step back a step.
Can everyone hear me?
Yep.
Thank you, Foster. Thank you, Vasant. That was really fascinating. And, Foster, as you mentioned in the introduction, although I'm currently an adjunct professor, I've been working in industry full-time for the past few years. So I'm not going to be talking about some of my own research. Well, I'm an academic, so I'm going to have to mention some of my own research, but it's going to be old research. I'm going to be mostly talking about some papers from the recent literature that I find really interesting and may not be as well known as they should be. And I'm going to put this in a framework for thinking about trust in AI systems in general. And I think Vasant and Foster, what you said absolutely fits into this framework. And so I think we'll have a productive discussion and questions afterwards. I'm going to try sharing my screen now. Okay. Yeah. So my title is From Explainability to Trust in AI Systems, because we've been hearing from Foster about explanations, and we heard from Vasant about trust. And indeed, explanations are really important. Trust is the bigger question. I have 6 themes that I'm going to try to touch on in just 10 minutes. And 3 of these themes have actually been well investigated by academics. And 3 of them, I think, need more investigation. They've been relatively neglected in the literature. So there's an interesting contrast there, I think. The first of the themes is, well, what actually is an explanation? And this is a paper which actually has not at all been ignored in the literature. This paper was published just a couple of years ago, and it already has over 1,000 citations, because it really makes a very important contribution to the computer science literature, which is to point out that there's a very large and deep literature in philosophy, psychology, and cognitive science about explanations. Because, of course, humans have been explaining things to each other, and scientists have been looking for explanations. Physicians have been looking for explanations in medicine for decades and centuries. And a lot of the early research on explanation in artificial intelligence, as the abstract here says, it used only the researcher's intuition of what constitutes a good explanation. But what this paper does is survey and go into depth about the literature from the social sciences and cognitive science. And of course, I'm a fan of this line of research, partly because when I was at UCSD, although I spent most of my time teaching computer science, I was very happy to be part of the cognitive science faculty also. So what actually is an explanation is something on which there is a large literature, although many of the researchers currently in machine learning and computer science are not paying enough attention to this literature. The next question that there is a lot of research on, but again, a lot of computer scientists and AI researchers perhaps have not tried to absorb enough is, well, we're talking about explanations, but what is the purpose of an explanation? What is an explanation supposed to achieve? What do we want to do with explanations? Explanations, as Foster and Vasant said, essentially we're giving them to stakeholders. And the stakeholder might be the data scientist who wants to improve the accuracy of a model, or the stakeholder might be a business person who wants to make a decision whether to deploy a model or whether to invest in improving the model. And the way that philosophers talk about this, they say explanation is an illocutionary act. So that's a very fancy word. What it simply means is that explanations tend to do something in the real world. That if you give a stakeholder an explanation that they like, then they'll trust it and they'll allow the system to behave. And if they don't like the explanation, if they don't trust the explanation, if they don't understand the explanation, then maybe they'll press the kill switch on the system. So what this paper and other ones talk about is, really, as it says, what explanation as a social practice consists in. As explanations are something that humans exchange with each other. If you think of the diagram that Foster showed of the AI is an independent system, and as Vasant said, it's very valuable when AI systems can make independent decisions, but there's still always humans in a meta loop who are monitoring the AI system and deciding whether to let it operate. And explanations tend to get involved at that meta level. The third theme that I want to highlight that there is a large literature on, and what Foster was talking about is an important contribution to that literature, is that in machine learning, often we focus on the word prediction. But in business, really, decisions are more important than predictions. Predictions are merely an aid that helps us make decisions. And this is something that has been known in the machine learning literature for many decades, but which we still focus too much on predictions. And so people keep relearning that decisions are separate and different from predictions. Like Foster and Vasant, I've been a researcher in machine learning for too many years. This is a paper from 2001, so 20 years old now. And as the abstract begins, this paper revisits the problem of optimal learning and decision-making. So it's making a distinction between decision-making on the one hand and then learning on the other hand. And the abstract begins, this paper revisits the problem. So even 20 years ago, this was not at all a new problem, but it was a problem that needed to be revisited. So that's the importance of going from predictions to decisions. And then something which is equally important, maybe even more important, is that decisions by themselves are often not enough. What we really are interested in is interventions. Imagine that we're a bank and we're making loans to consumers, as in Foster's example. Well, we want to make loans. We don't want to reject consumers. And so if we're going to reject an application, we would like to know how could we change the application so that then we could approve it. For example, maybe we can approve a loan application for a smaller amount. And the research that Foster was showing was exactly, I think, telling us, so we want to approve this loan, so how can we change the application so it becomes approvable? And if we reduce the loan amount, then we can approve the loan. Of course, you do get into system level questions, meta level questions. If borrowers know that their loan amount is going to be reduced and then it'll be approved, and maybe the borrowers will start gaming the system and always asking for a very large amount so that then they'll get the maximum possible. So you do have to think about feedback loops at a meta level. But the fundamental point remains is that decisions by themselves are not enough. We really want to be thinking about interventions. And this is a recent paper. Bernard Shokop is one of the deepest thinkers in machine learning. And as the abstract says towards the bottom, we propose a shift of paradigm from nearest counterfactual explanations to minimal interventions. Though this is also making the point that really explanations are illocutionary. An explanation is not just something that we discuss out of academic interest. The explanation is supposed to enable us to achieve something in the real world, such as approving a loan application that otherwise we would have to reject. So that was three themes that on which there is a large literature of academic research. And then I want to talk about three themes where there's much less in the academic literature. And so I think this is important opportunities for research, and which will be very relevant to business applications like I've been involved with for the past 5 years or more at Amazon, Goldman Sachs, and now in a startup. And a very empirical question is, when do stakeholders find explanations useful? When do humans find explanations useful? So this is also a recent paper. You can see it's from the AAAI ACM Conference on Artificial Intelligence, Ethics, and Society. And what the authors of this paper do, they conduct large-scale studies to measure the impact of different factors on perceptions of understanding, fairness, and trust. So one thing that this is saying is that part of the purpose of explanations is to generate trust. And when people look at explanations, they want to be able to conclude that there was fairness in the decision-making, and they want to understand the decision-making. But you could be understanding decision-making and then conclude that it was unfair. So understanding by itself is not sufficient. You also want fairness, and fairness is one of the inputs into getting trust. And this is a really interesting paper because the authors actually were psychologists. They found human subjects and they did experiments with them to find out which explanations tended to foster trust and adoption from the human subjects. So if you look beyond the highlighted box, the line below, it says algorithmic prediction rationale. So that's essentially another name for explanations. Mm-hmm. Now, something which I'm very aware of, having been involved with so many machine learning applications, is that there's a life cycle. And I can caricature this life cycle by saying, at the idea stage, it's all enthusiasm. We have a startup and we really believe we're going to change the world using machine learning, or we really believe that we're going to get a lot of alpha with machine learning for trading. And then, as almost anybody who's worked on a machine learning application knows, when you start trying to flesh out the design of the application, you get held up in, it's so hard to find good data. Maybe we have data, but the data is old and we don't know whether the data is still relevant and meaningful now. Or maybe the data needs cleaning, or maybe we have the instances, but we don't have the labels. In the implementation stage, often we find it's so hard to get high accuracy. Maybe we don't have enough training data. Maybe there's too much noise in the data. Then early in production, this is actually really where explanations become the most important. We're in production, we're happy, but then we have a failure. And then the stakeholders really want the explanations. Why did the system make the wrong decision? Why did we do a bad trade? Or this is an example that I would like to stress that I was not involved with and that I have no inside knowledge about. But a couple of years ago, there was negative publicity for the Apple Card algorithm because two spouses would apply, and then one of the spouses would get granted a card with a lower credit limit than the other one. And so people were complaining that this might be gender discrimination. And so then the stakeholders behind the algorithm that was making the decision, they really want an explanation. They want to know why did the model make predictions which then led to these decisions to give different credit limits. So my experience is that the real demand for explanations comes when the system is in production, but then has a failure. And if we're fortunate with our system, we manage to fix the failures, we manage to modify the data, modify the learning algorithm, add in guardrails, and the system starts operating well, and the failures become more and more rare, rather like bugs become more and more rare in traditional software systems. And then what's striking is that the stakeholders don't want explanations. Their attitude is, don't bother me, I'm busy, I trust you. And this is the emergence of trust. And the paradox is that when you have trust, then you don't need explanations. And then when the system really is mature, then people are paying less and less attention to the system and wanting to look ahead. What can we build next? The final point that I think is not discussed enough in the literature is, are our demands for explainability unreasonable? And this is actually a special case. Whenever we have a new technology, or often when we have a new technology, then the new technology actually has to be much better than an existing technology in order even to get the right to be deployed at all. Currently, in the United States, something like 50,000 motor vehicle fatalities per year. if we were deploying a new transport technology or automated cars, the fatality rate would have to be much lower than 50,000 per year for that technology ever to be authorized. And if we think about humans and how well can they really explain their decisions, we think about current business processes, how well can their decisions really be explained? Often we have a very notable lack of explainability. And this picture illustrates an extreme example of this situation. So this is a drug sniffing dog. And probably everybody in the audience has been through an airport and been waiting to collect their luggage. And then they see some agents who have dogs, and the dogs are smelling the luggage and supposedly picking up which suitcases might be containing illegal drugs. Well, the dog is a neural network. It's a biological neural network. And it's probably much bigger than many more nodes and parameters than any artificial neural network that's making any decisions in our daily life. And this is a completely unexplainable neural network. The dog just gets excited about a particular suitcase, and there's no possibility of getting any explanation of why it was excited about that suitcase. So we are willing as a society to tolerate current processes that completely lack explainability, but we are demanding higher standards from machine learning methods. And I agree, we should demand these higher standards from the machine learning methods, but we should be conscious that what we're asking for is a stretch. And by the way, this illustration also shows another common failing of machine learning methods. So often machine learning applications fail because the training data is not representative of the data that arrives in production. We might be training our trading algorithm on data from 2019, and then March 2020 comes along and the markets are completely different. The data in real time is just from a different distribution than the training data. And this picture is actually a drug sniffing dog being trained to detect drugs. And look at the packages that it's interacting with. They're all pretty much identical in size and material and shape and so on. Now, imagine this dog going out into the arrival hall of an airport where passengers have all different shapes and types and sizes of suitcases. So the production environment of instances for this dog is very different from the training environment. And so that's an error that we know not to make when we're training machine learning models, but it might have been happening when this dog was being trained. All right, I'll stop here. And I think now we have an opportunity for general discussion.
Yes, we have a few minutes left. So maybe stop sharing your screen and we can see everybody. And I'm going to take a question from the audience first. Could we speak to the identification and removal of bias in the overall process? I'll leave it at that. Maybe Vasant, do you or Charles, do you have something particular on that?
Yeah. Bias is plays out in different ways in different parts of AI. So in language, for example, you have these language models now, and they can be biased by stuff they're reading, which has gender bias, maybe racial bias. So machines can sort of turn to learn that bias in those domains. And in business, we've got all kinds of other bias. In financial markets, you've got an upward bias in the market. So there's that's one of those things that needs to be taken into account. When you construct the training set.
One of the things that we do is we actually use these explanation methods to try to identify, not necessarily get rid of, but try to identify bias. And so we look at the decisions that are made, and then the explanations can tell you the reasons why they're made. And then you can ask yourself, then you can sometimes notice that, wait a minute, that's not being made for the right reason. And then a lot of times that will then lead you back to wonder, why did it learn to do that? And then often, right, that'll basically indicate to you that there's some bias some bias in the training data. Let me actually move on since we have limited time.
I'd like to add something else on the topic of bias. I think there's a similarity between bias and explanation from a research point of view, that some aspects of bias, there's a very large literature. And then I think there's one important aspect on which there isn't enough literature. It's easy and common for people to see cases of bias and to identify the cases of bias, but it tends to be difficult for them to articulate actually what the absence of bias would be. It's difficult to say explicitly what fairness is. And to take the same example that I mentioned before of giving different credit limits to two spouses. I mean, what is fairness in this case? Is fairness always to give the same credit limit to two people who are married? Or is fairness to treat people completely as individuals, and one person might have an inheritance and the other person doesn't have the inheritance, and so on? So it seems to me there's a relative lack of research on positive statements of what fairness is.
Yes, and I think there's a difference here with research and with practice. I mean, I think in practice, you sit down and you work on trying to figure out what does it mean for my particular application right now, giving these credit lines to people. I want to actually bring up another question, because it actually it comes up very frequently, and that is, what about national differences? And like one example would be, we have GDPR versus we have California versus we have, the rest of the U.S. versus we have China with respect to the what it means to be, to follow the law for one thing, but then there's also ethical implications if you have certain laws. You guys have a...
No, that's a complete can. No, that's a complete can of worms. I'm not going there.
Charles, you want to?
Well, of course, I agree with you, and I agree with Vasant. It's a can of worms. I'm just thinking currently the example, which again I only know what I've read in the media. Apparently, I think it's Facebook has deplatformed the current government of Burma. Presumably the Facebook is not following the law in Burma, but it follows the law in most countries. Now, we could say that the government in Burma is illegitimate. And from what I've read in the media, I certainly think that would be my point of view, but it's a difficult question.
So I want to end on time since I'm one of the organizers, so I have that prerogative. Let me hand it back to you, Kathleen. Thank you very much, Vasant. Thanks, Charles. Thanks everyone for joining.
Thank you.
Thanks, you guys. Great panel. You guys, I'm sure, can see all the implications here from a person making a financial choice on an app where their decisions are shaped by a machine learning model that shows them different things depending on how they react to that. You can see how it could be shaped by an Asian super app incorporating e-commerce data and social media data. And you can certainly see the relevance of who gets to be in charge of these systems. So thank you, folks. That was a great panel.